Diversification is the golden rule when it comes to investing. You want to make sure that you're in multiple investments to protect your downside. The problem is that most investors are super heavily weighted into the equities market. So, stocks, bonds, but they're very light when it comes to real estate. In today's talk, John and I are going to be breaking down why it's so important to diversify into real estate and why real estate syndication can be a massive part of your portfolio to not only get higher returns, but to protect your downside and to be very well diversified with no extra work as well. Not only that, we're going to be talking a little bit about the tax advantages as well that most of the public equities markets won't allow you to get access to. John, it's great to be here with you.
It's great to be here, Mark. For me, it's something that I was a little late to the party on. I was in the real estate business, but I spent so much of my time focused on building the business. I was just kind of putting some money into the savings accounts and letting my financial planner do that work in investing. And I'm not one that have a lot of regrets, but one regret I do have is I wish I had bought more real estate. Especially when I look back on,
Mm.
gosh, the Great Recession, you could buy homes for 50, 60,000 in downtown Atlanta that are now selling for 600,000. But that said, the best thing you can do when you have those learning moments is take action, and that's what I've done. Right, so definitely diversifying more and more into real estate every day. And so really looking forward to diving into this topic.
Mhm. Yeah, John, it's probably the biggest regret that I hear from most people
Yeah.
is that, being a real estate broker investor, it's like, I wish I would have bought more back, 10 years ago, but you nailed it. Like the next best time is today
Yeah.
because
Yeah.
10 years down the road, we're going to be looking back at today and saying, I wish I would have bought more.
Yeah.
And it's hard to imagine, right? Because real estate pricing is pretty high right now when you look back and from history. But if you speak to a lot of developers out there now, they're telling you that, and they're telling me from multiple conversations that pricing needs to go up in order for their deals to pencil out. I
Mm.
spoke to one developer and they said, listen, I'm not developing at any price right now because the cost for developing and getting a product to market is just too expensive and the market's not paying him on the back end. Like the sales wouldn't be as high as what he needs to have the deals pencil out. So a lot of like single family in particular is just not penciling out, as well as like a lot of this multifamily, it's not penciling out. So that pricing eventually does need to go up. And so
Yeah.
10 years from now, I don't see a world where pricing is not higher because there's inflation out there. Everything is becoming more expensive and we're not seeing material costs drop significantly out there in the marketplace. And at the end of the day, what's proven to go up over a long sustained period of time in real estate's been proven to go up over time, and that's what we're going to be talking about: how you can actually add it to your portfolio without doing any of the work, and the advantage of doing that as well when it comes down to diversifying your portfolio.
Yeah. There's a Chinese proverb that comes to mind, that with that regret, right? They say, when's the best time to plant a tree 20 years ago? When's the second best time? Today. And so it's how I've approached it. But, I think diversification really matters more today than ever, right? And you're seeing more so where stocks and bonds are increasingly correlated. It used to be that, if the stock market was down, you'd go over to bonds or vice versa. But that balance isn't as provided as often as it used to be. And in addition, you have so many of these stocks are trading these massive index funds that the sort of fundamentals of that individual stock aren't really priced in like they used to be to the stock. So in other words, you can't really go back and rely on the quarterly financials to make a smart investing decision because there's just so many of these trades occurring once again in these large funds where the fundamentals of the business are now divorced a little bit from the value of the stock. And so, to be clear, this is not to say you should not be investing in the stock market. It's just more you should be thinking about ways you can diversify into other assets that will also produce some great cash flow and income and upside. But for me, one of the biggest thing is that ability, right? With market volatility, we have things like interest rates, political elections, tariffs, these all create unpredictable swings. On previous podcasts, we've even talked about how a very influential person could tweet something out and a stock could drop 20% the next day or go up 20% the following day just based on rumor and innuendo online, right? So diversifying into private real estate at the end of the day adds stability, cash flow, as well as an inflation hedge, which is one of the bigger points. But most importantly to me, it allows you an element of control that you don't get in the public markets. You can make an intelligent decision on the types of assets you're investing in, study the deal decks, and make sure you're making a right decision. And you can have some influence and control over your money that you lack in the stock market.
Yeah, 100%. And this is where it's really important, John, I think that we look at it in the equities market. It's at an all-time high right now.
Yeah.
And so on the other end of the spectrum in multifamily, the pricing's come down about 20 to 30% from the peak of the market. So, do you want to buy, for new dollars going in, do you want to invest more at the top, or do you want to invest in another marketplace right now where it's come down, where there's like the fundamentals are telling us that we're going to see a really strong run coming up because there's been lack of new supply coming that's been being built the last couple of years because developers haven't been building in these markets we're buying in, and ongoing population growth as well. So there's that side of it that we got to really look at. And then the other thing that's really important is that more and more money that's getting put into the alternative space. When I say alternative space, it's like uh, real estate, REITs, multifamily, the alternative space where they're looking to have further diversification outside of the equities market. And so, if these larger financial advisors and groups are looking to diversify, there's something to that as
Yeah.
well. And so, we have to keep in mind that real estate, the overall asset of real estate, is larger than equities in all debt combined, all of it combined. Real estate is the largest segment. And that's why, I mean, 90% of millionaires made their wealth investing in a real estate. So if you're 100% weighted, or even if you're at a very high percentage of like stocks and equities, really look at history of where did most of the people make their money, and where did you make your money, majority of your money? A lot of times it's in your principal residence, or you had a real estate investment outside of your principal residence where you made a lot of the upside. And, at least be fairly weighted in that asset class. And now, with the way that we've structured our deals, not wanting to fix toilets and light bulbs and all the rest of it, that used to be a reason why not to invest. But now, with the structure that we have, you're able to come in as an actual partner with all the upside without doing any of the work. And this allows you to really get back to a proper weight between, real estate and, the overall equities market.
That's right. So, some of the reasons why we think apartment syndications, which is what we offer here at Ferris Capital Partners, specifically work well for diversification. Number one is that they do often provide above average returns compared to the public equity market. So, historically, multifamily syndications target somewhere between a 15 and 20% IRR with cash flow along the way, right? So, once again, Ferris Capital Partners, we only buy deals that cash flow on day one. So, you're getting money coming back to you in return of capital on a monthly basis, and then you get to participate in that upside. And sort of looking at that and comparing it to the stock market, which typically averages about 7 to 9% annualized after inflation. Now, the key there is that's not every year, right? It's the idea that some years you might be up 12%, then you might be down 7%, but it averages out to about a 7 to 9% annualized return. And so, that's, smart to do. Put some money in those public markets, let it work for you while you sleep at night. But the passive structure really is the main thing for me that is so interesting because it means you get professional management without having to do the work, right? So many of the folks that invest with us, we have over 200 plus investors that have trusted us with their hard-earned dollars. That's the biggest piece of feedback that we get, that they love the ability to get the returns without the midnight phone calls or dealing with broken water heaters or late paying or residents that just leave in the middle of the night and leave the house trash, right? That is removed from the equation. We take on all that, and through our professional management we mitigate a lot of that just by really heavily qualifying these residents, making sure they can afford the rent, making sure we're checking criminal history, even things like prior evictions, right? And so it's not a guarantee. Every property, I don't care how good you operate it, will have some people who just skate on you or don't pay their rent. But because we're investing in landlord friendly states, we can make a quick decision, evict that resident, and bring in a better quality resident that'll be a better fit for the community long term. So that above average returns is one of the strongest reasons why apartment syndications are a great way to diversify.
Next, we're looking at real tangible asset backing investment. So this is where you can actually go and touch it and feel it. It's not. It's harder to manipulate it as well. I like the fact that I can go touch the building that I own.
Yeah, yeah,
I don't, like it's just something, and a lot of our investors like that too. It's like they can go and drive up, and a lot of our investors do. They go do a drive by the property. Not only on Google Maps they can see it, but they can actually go and touch it and feel it. And so this to me is like, okay, there's something that's adding value there. It's actually supporting somebody's home. So this is like that's why we really like apartments, because people will always need a place to live ultimately. So not only can you touch and feel it, but this is putting a roof over somebody's head that is they're making good income. Yeah, like so at the end of the day, you got to look at from an investment standpoint. I want to bet on putting food, shelter, and water. Right, those are the main essentials.
that's
And
right.
so food, water. Maybe one day we'll get into a business that provide that, but like shelter to me is something that's one of the big three.
Yeah,
And so that's something that you don't get direct with the equities market. And coming in as a partner in these deals not only allows you to take advantage of it, but taking advantage of it as an actual owner versus getting a coupon where you get X amount of percent. You get all the majority of the upside in these deals is how we structure. You're coming on as a partner in our GPLP structure that we set up for our investors.
that's right. So number three is the cash flow along with equity growth, right? So some groups do quarterly. Here at Ferris Capital, we do monthly distribution. So you're getting steady income coming in on a regular basis. And then we're forcing appreciation through renovations and operational efficiency, which will actually help grow your equity, right? Because the magic of this is for every dollar in NOI we add in a monthly basis, that is increasing the value of the building by $240, right? So that is the secret to these deals and why they're so strong and so compelling. And along the way, you're benefiting from both short term cash and long term upside, which is one of the reasons. And we've had a talk on here. We've done a podcast on the difference between an apartment syndication and a REIT. And it's not to say you shouldn't be in REITs, right? It's probably a good way to diversify even within some of those equity markets. But the idea is that with a REIT, you're getting your monthly coupon, you're getting your distribution, but if they kill it and sell a building for a massive profit, you're not getting a slice of that. You just get your coupon rate that they've offered. So I think for us, it's that ability to get the monthly cash flow and participate in the upside, which makes apartment syndication particularly compelling.
100%, John. Just quickly, a couple of the large Canadian REITs they've actually paused on their redemption option.
Yeah,
And so what you used to think where you could pull your funds at any time, they're saying, no, you can't pull your funds right
yeah,
now. So even though you're maybe getting a lower return, you think you can pull them there. That's always an option that they have, like buried in the fine print. So at the end of the day, you just be aware of that. The next point here with these deals that we structure is these tax benefits. So on the American side of the border, you get the 1031 exchange, so you can roll over into a from one asset in like kind exchange where you can roll over the gain and not pay taxes on that. There's bonus depreciation and cost segregation studies that allow you to mitigate income in another area to be able to lower your overall tax basis. There's that, and on the Canadian side, there's depreciation as well that you can utilize. But the bigger thing on how we structure it, which trumps all of that, is that our distributions is return of capital, and so that means that during the whole period, that you're not actually paying any taxes during the whole period based on the structure that we're doing. And then when we sell the asset in 3 to 5 years, then the total gain is taxed as a capital gain, which is only half than you would with any other. We'll say if you're investing in a mortgage, you're getting monthly interest as income, or maybe with stocks, that's taxed at the highest rate. Whereas with our deals, the overall upside and the overall returns is taxed as a capital gain. So here's an example. If you invest 100,000, and let's say you go in our A class share, which B, C, and D is between 20 to 22% annual returns in our deals. But the A class, we have a certain percentage where you're getting a straight 12% return, okay, on that. So that comes in a preferred spot. So you get paid that out first. So you invest 100,000. That means that you're making $12,000 a year or $1,000 a month coming in. Over a 5 year period, you're getting 60% overall. So 12, 12, 12, time 12 times 5 is 60,000. So in our deal, let's just say you invest in our deal, you're getting that 12% overall return. And option B is to invest in a mortgage. And so you're loaning some money. You're investing $100,000 and you get $12,000 in a return or 12% on that mortgage. So that's example two. The beauty of this, in both cases, you made 60,000 in overall return, but in our investment, you're not paying any tax along the way. That 12,000, because we're reporting it as return of capital. So there's no sort of tax liability during the whole period. Whereas with the mortgage, you're having at the end of the year file taxes and claim the full $12,000 every year as regular income. So you get all of it's getting taxed at your highest tax rate. And then, but when we sell our asset, then it's not taxed as regular income, it's taxed as a capital gain. So the $60,000 that you made, only half of it, 30,000 is taxed your regular income level. So even if you're at the highest tax rate, let's just say 50%, that means that only $15,000 is actually going towards tax, which is half of the $30,000. Whereas the other investment, uh, the full 60,000 of it is getting taxed your regular income level, which could be actually double the amount of taxes, or 30,000 that's going towards tax.
Hmm.
John, this is a massive, massive advantage, because even though you're getting higher returns in our deal, you're actually paying in a lot of cases almost pretty much like half you would as you would in another investment. And so this is, not only do you make higher returns, but you keep more in your pocket of the overall returns that you receive. I'm just so like this is such an important point for the investors to really understand that
Yeah.
it's not how much you make, it's how much you keep. If you can get higher returns and pay less in taxes because of the structure of the investment, this to me is a massive, massive win, because over time, that extra win that you're getting every single year, it accumulates into huge returns. So down the road, you can actually retire a lot sooner than you thought. You're going to have more in your pocket at the end of the day because of the tax structure, and that we've taken the time to position and structure our deals in a way that allows our investors to maximize how much they put in their pocket after taxes.
That's right. And then, in the US, right, we do have investors in the US. You've got bonus depreciation, cost segregation, and a few other things like the 1031 exchange. So if you're a US investor, we didn't spend a lot of time on that. Booking a time to talk, we'd walk you through some of those tax advantages that are offered to you. But the last one really is the way that these deals are not correlated to public markets, right? So private real estate doesn't move with daily stock market volatility, right? A bad piece of economic news hits, it does not impact our rents. Those rents are set in stone for 12 months when we sign those residents. And, on renewals, right? So maybe there's a major economic issue and our renewals are a little bit less than we projected, but because we're overshooting our projections and we stress tested our deals, we have that baked into the underwriting. And, syndications or apartment buildings aren't priced by investor panic, right? They're priced by income and expenses. It's just the math, right? So, what is the property producing in terms of NOI? Now, things like cap rates can fluctuate based on market sentiment, but that's where stress testing comes in and the ability to have a 5 year hold plus an optional 2 year extension. So, we can time it at the right time. I mean, really candidly, in year three, we start getting broker opinions of values to see when is the right time to exit so we can optimize those returns for our investors. So, at the end of the day, we're just not subjected to, the headlines or, political winds or anything like that. And for me, it really provides real diversification, not just more exposure to market sentiment, right? Because at the end of the day, as I mentioned, these assets are non-correlated to those public markets. So it's really true diversification versus saying, oh, I'm going to take some of my money from stocks and put them into bonds. I mean, that is diversifying, but you're still tied to those public markets and market sentiment. So a very important point there.
Yeah, 100%. I mean, you're getting like all the above in a big way. I mean, I would
Yeah.
say we'll just call it for what it is, John. The one thing with our investment is that our investments are tied up between 3 to 5 years because
Yeah.
it's going to work. And so if you're to say, okay, but what's the downside in the investments, like, and where maybe it's not the right fit is if you're not prepared, or if you're living, or you would maybe need it for emergency fund to get access to it, that we may not, what we do may not be a good investment for you. And so
Yeah.
we tell our investors when we meet them, it's like, listen, here there's so much upside in these deals, but the one thing, just be prepared. 3 to 5 years, that's the horizon for these investments to fully play out. And so in some cases we let investors know, like, this probably isn't the right fit,
That's right.
because they're like, I might need to get access to this because I want to buy a car, or I want to get buy property for my kids. And that's great if you need access to it. But if the funds are sitting there and you're looking to get an extra 10%, just remember that an extra 10% over 30 years works out to, like, if you invest $1 million and you get an extra 10% over a period of 30 years, it works out to like $14 million extra in your pocket. Like, it's significant by getting higher returns. Not only that, if you can keep and only pay half the taxes you would compared to another investment, really looking at that and doing the analysis and making your decision is something that's really important. So you're getting a lot of benefit in all this, but just know that when you're making that final decision, like, the kind of upside that you're doing, but being prepared 3 to 5 years as well.
That's right. So at Ferris Capital Partner, how we structure for diversification. So monthly distributions typically begin by month three. We've actually been trying to make some moves to even get that started sooner. So it's cash flowing on day one. That first distribution is a catch up, and then those distributions continue monthly. We underwrite conservatively, and we only buy deals that cash flow on day one with our reserves as well, which is another one of our golden rules, having strong reserves in place. We can't guarantee, but we can ensure cash flow will continue. And then we offer multiple share classes. So investors can kind of choose between an income focused approach or growth focused strategy, or a blend of both. And for those that invest more, the unit economics increase. And then the transparent communication, which is a big one. Mark, it was interesting. I think right before we jumped on this, I told you I was kind of watching a webinar on an investment I'd done, have some capital in. And the last update was in March, and so it was just, I mean, it was good to get an update, but I'm like, that's the best you can do, like every 6 months, right? And so those monthly communications, we guarantee they go out on the 30th of every month, 28th if it's February, and we're going to be very transparent with everything that's happening, good news, bad news. Lease trade out. That's one of my favorite things to report on. I know it is for you as well, but we had this unit. This was the rent. We renovated. This is the rent. This is the value created. We include things like Google reviews. So it's very transparent. You'll always know what's happening at our properties.
Yeah, 100%. So just to summarize here, apartment syndications deliver diversification beyond just stocks and bonds, and also you further diversification. If you're Canadian, you have primarily Canadian real estate. The U.S. dollar, getting access to that is something that delivers diversification in a much greater way. And majority of our investors, they love that kind of diversification. Cash flow, equity growth, and tax advantage is, it's really hard to find these types of investments where you get all the above. And multifamily real estate, especially because we buy larger apartment buildings, it gives you much more resiliency in your investment. So if one tenant moves out, you still have 99 more to pay. So it helps, like, really anchor in your overall returns. And if you do want to learn more on how to invest and partner with us in our next opportunity, go to fulloutinvesting.com. By doing that, you're going to be able to have a better understanding of what our typical deal looks like. And you can book a one-on-one call with myself to be able to find out, is this a good fit or not, and to get on our list to be able to get access to our next deal. Thanks for listening, guys. If you enjoyed the show, you can go ahead and subscribe to the channel and share with any other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe you guys. Keep dreaming and investing big.